Hello everyone, my name is Kamal Manocha. I represent PMS World. Over last 1.5 years, we have had, I think, one of the most interesting and very unique times for equity markets. Equity markets have kind of given a phenomenal run. A lot of investors have, I think, missed this rally, but at the same time, there have been, long-term investors who actually understood the concept of equity and have learned to invest in equity by focusing more on returns and focusing less on risk have actually made a lot of money over the last 1.5 years. Now, because we are an intermediary, we represent investors' interests. We understand market valuations. We understand, where markets are headed, and we have been doing a lot of these intuitive talks with fund managers on weekly basis. And based on that, we have recently, tried and deep dive one very interesting idea and one very interesting product, which is in the fixed income space, which is what we are going to discuss today. And particularly, we are not going to talk about this product per se, but we are trying to understand this space because this space has a potential to generate maybe around 12% kind of return. I'm not quoting any number here, but I'm just trying to tell you indicatively, and it is a very decent return for one to actually kind of create returns in fixed income. Today we know fixed income space has actually become very boring for a lot of investors who are invested in somehow ultra short-term funds or arbitrage funds, and at the same time equity markets have become kind of so much confusing, and it is testing a lot of investors' patience. So that is where it is important to understand the space of alternates in the fixed income side of it, and that is where this particular idea and product is all about. So more about education, more about learning this space is very, very important. So we will deep dive this. So I'll give you quick expectations for the first maybe 15, 20, 30 minutes. We will do a presentation where Karthik, who is the fund manager of this particular product, will take us through the details about this particular product, and then in the second half we will have a detailed discussion in terms of answering a lot of questions. I myself have many questions, and we will note down questions from the audience. So I'll give you a quick introduction to the speakers that we have today. We have Mr. Vijayendiran, who is the CEO with Sundaram Alternates, and he brings with him more than 34 years of experience. Particularly with Sundaram Alternates, he has been working there for last 25 years. And with him, we have fund manager Karthik, who brings with him 22 years of experience. He's a chartered accountant, as a professional, and also, his forte is investment banking, corporate finance, and because this particular product, deals with financing, and it is important to understand the roots of Sundaram because Sundaram's roots come from financing, and it is into multiple businesses, and all that will be covered by Karthik, where he will explain us the origination of this particular platform on Sundaram and how is this platform doing broadly. He will then also give a detailed, I would say, a detailed introduction to the fund manager Karthik, and then it will be over to Karthik for him to discuss about this product, and then we will take questions and answers. Over to you guys. Welcome to you, and thank you for joining us. I have given a detailed introduction, but I would also like to give 30 seconds of welcoming you formally to now take it over from here. Over to you guys.
Thank you, Kamal. Thanks a lot. Thanks to PMS World for giving us an opportunity, and I thank every one of you who have logged in today, taking off some time from your busy schedule and being in this webinar. I'm sure you will be benefited by the presentation from Karthik. Before that, I just thought I will take a couple of minutes to introduce you about Sundaram Alternates. Just to have one correction of what Kamal was introducing me. I've been with Sundaram for the last 25 years, not in Alternates. Alternates is a 4-year business. Prior to that, I started with Sundaram Asset Management when the company started in '96. I've been with them. So I've been in the mutual fund space before I moved into the alternate space when we created a different company. Just to quickly give you a perspective of what is Sundaram Alternates. Currently, we manage close to 4,000 crores of assets divided between PMS, that is Portfolio Management Services. We do equity long-only funds in PMS. And we also do alternate investment funds, basically both the category 3 and category 2 AIF funds. In fact, just to give you a little more detail on the PMS side, the PMS strategies, we have 4 key strategies, and these PMS strategies have been started way back in 2009. So all of them have a good 11-year track. The AIF funds we started launching from 2017. As you may all know, the AIF regulations came after 2013, and we started launching our AIF funds in 2017. And both were part of Sundaram Mutual Fund till 2018, where we decided to spin off a new company called Sundaram Alternates. And we moved PMS and AIF into this company, and I became the CEO. And Karthik just joined us from his earlier company called Clearwater Capital. And Karthik runs the private credit business. He heads the private credit business. His mandate is to grow that category 2 range of business for us. And so in just coming back to the PMS side, we run a fantastic 4 strategies, which I am sure you should go through it once you have some time about our performance. We run multi-cap concentrated portfolios, multi-cap diversified and dedicated mid-cap and small-cap strategies, which really covers the spectrum of the entire equity as an asset class in India. And all of them have done very well, averaging about 18 to 19% CAGR performance annually and beating their respective benchmarks by 8 to 9%. So that is the type of track record we run. Our PMS strategy is not well known, but we have acquired over a period of time. We currently have more than 3,000 clients in our alternate business between PMS and AIF. We deal with about 250 distributors and bankers across. And we also manage offshore mandates. We advise in the equity space, and we are also building our offshore in the private credit. We are on the work to build more business in the offshore side, which will feed into India in our private credit, especially in the category 2 real estate funds. So beyond this, I would like to hand over to Karthik. Karthik comes with, as Kamal introduced, has a rich experience of almost 20 to 23 years and dedicated real estate experience of more than 10 years prior to coming to us. He ran Clearwater Capital, Pan-India, Pan-Asia real estate fund, and he also promoted an Nbfc under that to lend to more real estate in India. Built a large business before he moved out and joined us way back about 4 or 5 years back. And he runs successfully 2 funds already in the real estate space. And currently we have just launched the 3rd fund. This presentation is on the 3rd fund. And interestingly, it will be very, people hear about real estate, a tough asset class, lot of NPAs. That's been the question being posed to us the last 3-4 years when we launched our first fund and the 2nd fund. I just want to inform all the investors, all the people who are in this webinar, the first fund, which will close next year when we end the tenure next year. Today, as of today, as I speak to you, we have almost repaid 83% of the capital people have invested in that fund. Suppose somebody has put in 1 crore of money in the AIF, in our first fund, real estate fund, they already got back 83 lakhs by way of capital back, as well as regular quarterly distribution of interest. Almost 332 crores we have repaid till date. As I speak to you today, we have repaid almost 332 crores of capital, as well as interest distribution. All this during the last 15 months, all of you may be aware, we have been going through the COVID tough times, and all across sectors have been affected, including real estate. But we have managed the assets quite well, and we continuously repaid interest and capital back to investors. That is the type of funds we have been running in the real estate space. Tough asset class, but we have really done very well in both the funds. That's where we are coming with the 3rd fund, and I leave it to Karthik to speak more on it, more in detail. Over to you, Karthik.
Thank you, Vijay. Thank you, Kamal. While I speak, Kamal, may I request you to bring up the presentation? Good afternoon, good morning all. I just want to say that, private credit, alternate financing, all these seem like buzzwords. I have actually been investing in a series of whether it is structured finance, senior secured loans, all forms of credit. From 2006 onwards, I think there is some noise at the background. From 2006 onwards till 2021 as we speak. So essentially, long before the AIF regulations came into play, I have been making investments just by way of personal track record through Clearwater and through Altico, which is the real estate vehicle that I set up, and I left them in 2016. With 3,000 crores on the balance sheet, 1/4 of capital, and a 23% realized IRR. And then I moved back to Chennai after 16 years in Mumbai, and really began working with Sundaram Group to build out this business. So, just by way of a quick introduction, diving straight into what we are discussing and what we are talking about. While the content is on the slide, essentially, when one talks about alternate financing, one is essentially talking about areas which typically banks, which are the lowest cost capital providers and the largest capital providers in India to date, cannot do. So essentially, these are a series of opportunities, whether it is end users of money, whether it is situations, whether it is type of sectors, whether it is kind of transactions, which typically Indian banks cannot lend to, because if they could, then all Indian promoters, as you might know, would queue up outside them, because they not only provide scale, very high loan to values, but they also provide very low costs. So essentially, private financing and alternate financing means implicitly, at least in our world, businesses that you don't compete with PSU or private banks at all. And increasingly now with the Nbfc dislocations and the greater RBI oversight, whether it is a non-bank finance company or whether it is a housing finance company that is actually doing things other than retail mortgages, those are also finding it difficult with greater RBI oversight to compete in these markets. Now, this is really the genesis of Sundaram to, as Kamal mentioned, start a private credit or an alternative financing business way back in 2016 when we got together. Essentially, the goal was to create 3 or 4 credit themes, starting with real estate credit, where, as Viju mentioned, we have 2 funds performing fairly well in the market, and we are launching the 3rd. In the later part of this year, we're going to be coming out with a corporate credit fund, which is non-real estate, which again, as I said, addresses end users that banks and typically NBFCs, etc., would find it difficult to finance. And that's really the clear and present opportunity over the next 5 years, 10 years. And there will be variations of these opportunities, but this is essentially what we're looking to do. And in the course of the next couple of years, we are likely to come out with further variants of private credit strategy. ESG would be a theme, some form of stressed corporate situations, not going into distress and IBC, etc., but stressed, etc., where a credit model is workable, are sort of themes that the board of Sundaram has approved over the last few years. But essentially, what I wanted to bring to your attention is there are a series of end users where the opportunity across real estate, non-real estate, stressed, ESG, etc., could be annual liquidity requirements of anywhere between $15 to $30 billion in a 2.5 trillion debt market in India today. And the key takeaway from this slide, would be that, just to give you a sense of why this opportunity is so huge and why Sundaram as a group has, endeavored to get into this and set it up institutionally and looking to grow both the base and the width of the pyramid, is a reason that if you simply take one summary statistic, where in developed markets like the US, even within Europe, Germany, and so on, developed markets and economies, the ratio of the bank to the non-bank market, is clearly the non-bank financing market is closer to almost 75-80%, wherein commercial traditional banks, participate in the market only in traditional forms of credit, which is more in the region of personal credit, transactional banking, and so on and so forth, where essentially all risks, whether they be project level or entity level or promoter level or early stage level or whatever it may be, are essentially taken by non-bank finance companies. Those could be private lenders, funds like Blackstone, and so on and so forth, which include, in the Indian parlance, us as well. And essentially, we feel that India today is completely inverted, where 80% of the risk in the market is taken by traditional PSU and private banks, and the balance is actually taken by the non-bank sector. We feel that over time, this ratio has to invert and become closer to where developed markets are, as the scale of the economy grows, as opportunities emerge, as the depth of businesses and markets. Definitely, we see that 15-20% non-bank participation moving to 30-40%. And that is a massive opportunity if you look at reclassifying a 2.5 trillion market and growing anywhere between 2 to 5% a year. That is a huge opportunity for us to be present in. And this is also evidenced by the fact that, there are lots of foreign funds, etc., coming in and trying to set up shop, where we believe that, they are trying to come from outside in and try and picking off the low-hanging fruit. We, by virtue of being in the market for decades, and Sundaram Finance, as you know, is a blue chip, highly reputed company which has been in the market for close to 7 decades of lending and understanding businesses and nuances of India and so on, is in a unique position to actually build out this business, considering the fact that we're already conservative, highly present lenders in the market with businesses like insurance, with home finance, mortgages, a mutual fund, both in credit and in equity, which gives us access to a significant number of promoters in the small and the mid cap and sometimes the large cap space. So considering the ecosystem that Sundaram has, the genesis of why Sundaram Alternates was set up 4 years ago, and why we are systematically building the private credit business, and indeed my role is because of this trigger. So that is the biggest sort of takeaway from this slide. So now, moving quickly into the first strategy that we have on the ground, which is really financing developers. I know that a lot of, as Viju mentioned, noise has been there over the past. I think real estate is a favorite whipping boy of the markets, and essentially, if anything goes right or goes wrong, there is always, some developer has made too much money, or they've done fraud and so on and so forth. There is significant noise on guys coming into the market to finance various stages of real estate. There is news about Piramal, the largest lender, going bust, and having billions of dollars of their portfolio looking for rescue. Now, bear in mind, all of this is true. But having said that, we find that because of 2 or 3 reasons, in the first being that at the end of the day, there is a tangible asset that one is looking to finance. 2 is that that asset is an inherent need, which is housing, which is where we focus on, which is residential. That is very, very inherent and indeed part of the government agenda. And you can see even during the Modi administration, the focus on affordable and so on and so forth. So there is an inherent demand for housing and residential that continues to fuel the need to build homes across the country. And so there is a cash flow generation concept that is embedded in the space. The third is, there is a reasonable ability to diligence that particular asset and sort of structure an investment instrument that is going to best generate cash and returns from that particular asset. So essentially for these 3 reasons, we think that the opportunity in real estate, despite all the noise and so on and so forth, is a cyclical sort of industry where it will go through peaks and troughs. And I will run you through that in a second. But essentially what that results in is a constant demand for capital, whether it's a small scale developer or a mid-size tier 2 strong developer in their regional micro markets, which is really our target segment, or a pan-Indian or a large well-known developer, whether they be the DLFs or the Prestiges in Bangalore or the Brigades of the world or the Oberoi in Mumbai or so on and so forth. Essentially, across the spectrum of real estate developers, there is a concept of an enterprise. There is multiple projects that they look to aggregate to build equity value amongst themselves. And consequently, at the base of their own enterprise, there are a series of projects that are generating cash, which are in requirement of money, and which essentially look for these kind of opportunistic situations. While they may sound opportunistic, they are very, very systemic, very continuous, very repeatable. And I've seen multiple cycles in my own investing career between 2000 to 2010, when it was a complete bull market, and any land or anything that you bought in the early part of 2000 was generating a CAGR returning 10 to 15% depending on where you bought it and what is your time frame and so on. Or even between 2009 and 2012, post the GFC, global financial crisis, there were spikes up and down, but essentially Mumbai market, for example, where I personally invested, made money over those 4 years. And then between 2013 and 2016-17, because of the significant amount of liquidity that came from NBFCs like DHFL, Kamal, Edelweiss, even private banks like Yes Bank and so on, there were a significant amount of capital appreciation that one could see, but demand was sort of tapering off, inventory was building. It's a different sort of phase and a cycle between 2013 and 2017. And then, of course, 2018 to 2021, there are a series of dislocations, starting with the demonetization, then the invent of RERA, which in our opinion is the single greatest benefit in terms of corporatizing and making the sector more transparent started to happen. And there is a concept of the customer as a creditor today in the developer's mind, where he cannot fool around beyond the point. He has to commit to deadlines, he can't divert cash, and a whole series of positive corporate sort of initiatives that impacted the sector. And then, of course, we had GST, where the entire amount of GST could not be passed on, especially for projects in construction and so on. So that required further liquidity as well. And then the Nbfc dislocation happened in 2018, starting with ILFS and then being a contagion into the space and created all sorts of ALM issues. And they suddenly went out of the market. And there was again a requirement of significant liquidity because sanctions and term sheets and commitments could not be honored. And then, of course, we had COVID, which nobody would have anticipated, sitting a couple of years ago, which suddenly influenced, logistical issues in terms of buying behavior. Indeed, nuances in terms of why people would actually want to buy a home, upgrading homes from 2 to 3 BHK, 3 to 4 BHK, and there are nuances now which we understand and begin to understand in terms of how these are happening within our own portfolio, where we see significant credit events that have impacted not just the real estate space but the general corporate space also in the last 4 years between 17 and 21, which has created a series of aggregated liquidity requirements on the one hand and consolidation at the other hand as far as real estate is concerned, where projects which could not take off, projects which could not be delivered by a developer, etc., either were stalled or changed hands, or essentially there were an entirely new set of projects that were launched by guys who could deliver, where customers had mind space and confidence, etc. So as we went through this cyclicality of events and their impact on the business, we found very, very interesting niches in terms of opportunity to invest, whether they be solving project level cash flow mismatches, which is what we do. And we really don't look at enterprise stress, distressed, etc. These are developers who are otherwise doing well, but they have project level issues in terms of existing loans, maturing too quickly and the underlying project generating cash on a different trajectory. So sort of normalizing that and giving them top-up financing or last mile financing or bridge financing, where essentially a lender had to exit for whatever reason, or a fund had to exit, or an NBFC had to exit because of their own balance sheet issues. Nothing really to do with the project. And, all of those required components of capital, and at the end of the day, all of them resulted in an asset value improvement, generation of cash, etc., which is the fundamental thesis for any investment in the space. As Sundaram, we've chosen to do investments in real estate more as a senior secured credit, fixed income sort of orientation versus a equity early stage project financing kind of orientation, which is typically what happens in the space. So we think that what this slide is trying to convey to you is that while real estate may have gone through different trajectories and different cyclicalities over the past 20 years, essentially there have been opportunities at every single stage, and right now the opportunity is very, very amenable to a credit sort of orientation, where one can actually get between 18 and 20% gross IRRs. Simply because this is a regulatory arbitrage business, as I started off this whole presentation, and there are unique opportunities in the space, even within where we focus, which is really the south of India. And so we think that for the next 5 to 10 years, this is a very sustainable business where we can easily deploy anywhere between 500 to 1,000 crores a year. And our team is sort of geared and built to sort of deliver that. and the goal is to try and deepen the base and increase our AUM, but at the same time not trying to do heroic things in terms of trying to raise massive quantums of capital and struggling to deploy. Our fundraising has always been humble and opportunity oriented, where the first fund was about 400 crores, which we fully deployed. As Viju said, we're 83% capital return, and that portfolio is at a 19% IRR at this point in time. Fund 2, which is a 435 crore fund, which we closed earlier this year, where we are close to 60% committed. We are 75% drawn. We will be 100% drawn and 100% deployed by the end of this year. That portfolio of 5 investments of close to 250 crores is also generating a 19% IRR right now. Fund 3 is a 750 crore targeted fund, where our goal is between now and April next year to try and raise that capital, because we see significant opportunities in the wake of all the credit events that I mentioned to you. I've already gone through this, but just to put numbers to the theory, why we say this is a regulatory arbitrage business is because if you see in this slide, essentially, one would argue that PLR is what it is, between 9, 10, softening interest rate regime, essentially, people looking at high growth and lower credit offtake, etc., etc. But these are opportunities currently in real estate, which we have highlighted here. But these exist in the non-real estate space as well, where there are pockets of end users and opportunities, as I mentioned, which actually enable the charging of a premium simply to provide that liquidity to that opportunity. So these are opportunities, for example, that banks cannot finance in the residential space. For example, banks cannot do a refinancing. Banks will not be able to do a takeout plus a last mile. Once they've committed to a construction financing model, they will not be able to change it and then go and say, okay, for additional approval, if the base case has changed, let me give you some more money. So there are very, very high levels of regulation imposed by the RBI on banks. And currently, they are massive capital providers to the space, and they can no longer top up on the construction financing model. Also, they have limitations in terms of their overall balance sheet that they can lend to the space. I think 5% of net owned funds is really what they can commit to real estate. So as a sector, real estate naturally lends itself to alternate financing or private credit, where there is limitations on banks to be able to provide capital. And even within that, they can only do construction financing, which is slab-based funding. And so the nuances and the flexibility required by developers cannot be provided by them. And so consequently, you see, while working capital interest rates for non-real estate typically maybe 10, 11%, maybe sometimes 12, 13%, we can easily lend at anywhere between 14 to 15%. So there is, and in our case, we're lending at 18, 19%, largely to brownfield projects and, end users towards the project. So essentially, there are massive amounts of premium that one can charge on a fixed return, preferred return basis without going into variable floating rates and so on, which make this a secured, highly visible cash flow generation sort of potential. And I'll explain why I'm using these words in the next few slides. But essentially, the regulatory arbitrage and the illiquidity, as I've mentioned here, is driving a lot of the premium that can be charged by people who are focusing on this space. As I mentioned before, I think these are a couple of the end-use opportunities just to give you a greater sort of sense of, what are the kinds of opportunities that we've financed in Fund 1 and Fund 2 and which we're looking to do in Fund 3, are essentially this, so project financing, where we really are looking to solve cash flow mismatches at the project level. Interim or bridge financing, where, we've actually done transactions here where financing is required for 12 to 18 months, sometimes maximum 2021 months, where, it is possible to make between 20 and 21% IRR simply because you've solved that particular issue, either on that entity or on that project. And, essentially there is a high visibility of cash either from the project or, from a refinancing model, where currently as we speak, in a fully leased commercial building, we took out SDI, which was running into delays on one of the residential projects of that developer in the south, in Chennai. And, right now, that whole asset is looking to be sold at 2.5 times the value of our loan plus return. And so essentially we're looking to make like a 21, 22% IRR realized from that trade in about 18 months. So there are bridge type of opportunities that emerge. Then there are enterprise level, rescues, which is not something that we've done in Fund 1 and 2, but we are seeing opportunities here where, for example, there are very, very high quality developers who historically have leveraged quite a bit. And as I mentioned, some of the NBFCs that have financed them can no longer continue to commit or deliver on their commitments. So, there are undrawn limits which cannot be drawn anymore, and they are running short of liquidity. So, there is a deal possible where we finance them and essentially get first charge on the projects and actually make the senior secured lender today subservient and a second charge to us, where we come in last in, first out in terms of cash flow, and we are able to make 18-20% return. So that's opportunity that is emerging. And then, of course, we have in our PPM in Fund 3 specifically alluded to special situations and, warehousing, commercial, and so on. While 80% of our focus continues to remain residential, we think there are opportunities similar to the one that I mentioned, where it is possible to do shorter term financing and get 20-21% returns on a senior secured basis, that are possible. So we've allocated some capital to that, but these are all essentially end users that, are capable of being, funded at pretty high returns. And all of these are on a senior secured basis where there is anywhere between 1.8 to 2.5 times cover, on our investment. So if we make a 50 crore investment, we have 100 crores of tangible assets which are mortgaged and escrowed from a cash flow perspective to us. So these are all significantly secured with massive amounts of equity that lie below us, which is a very positive incentive for the developer and the counterparty to be able to take us out of their balance sheet at the earliest possible time. So this is something that I mentioned, and these are numbers in front of you in Fund 1 and Fund 2. As you can see, we've made around 17 investments, committed close to around a little over 800 crores of capital in the last 3.5 years. And as you probably know, this is probably the toughest vintage that any fixed income fund can probably raise money and deploy in a sector that has seen the brunt of, demonetization, RERA, GST, NBFC crisis, then COVID, wave 1, wave 2. So essentially, the funds that we are talking about and our investment strategy and our credit policy has actually withstood the test of all of this. And in fact, if I'm not mistaken, during the COVID lockdown between March 2020 and March 2021, we have collected, I think we were probably, I'm not aware of a second, but we did not jump on the moratorium bandwagon. Our assets at the borrower level continued to generate cash. We gave no moratoriums and essentially collected between 250 to 300 crores out of the 400 crores of Fund 1 during the COVID lockdown. So, that says something in terms of, the resilience of the sector. And if one is able to underwrite properly, enter the projects and the company at a right phase or stage, and, write your own documents in terms of creditor protection and downside rights, and be able to, for lack of a better word, high oversight on cash and escrow mechanisms, it is possible to generate returns and derive cash on a consistent basis. And as Viju mentioned, we've not missed even 1 quarter of income distribution back to our investors. And, Fund 1 is 83% distributed, and Fund 2, although we closed in February this year, is already 11% capital back, because our policy is to distribute on a quarterly basis 100% of the income that we generate from the underlying portfolio, whether they be interest every quarter, or they be fees, or they be redemption premiums, etc. All of those are 100% distributed back, so that our logic is that while at the asset monitoring or the deployment level, we consistently take risk off the table. At the investor level, he continues to see consistent cash and a yield, which is similar to what he would find from any fixed income investment, and so on. And obviously on a senior secured basis, and with priority charge on the cash flows, a gross return, our investors have made gross returns of anywhere between 15 to 16% in Fund 1 and in Fund 2, which we think is pretty interesting from a risk-adjusted return point of view. And obviously, Category 2 is a tax pass-through. So obviously, taxation is subject to what their own taxation jurisdictions is. But essentially, from a track record point of view, this is what we've delivered in the last 3.5 odd years. We continue to be bullish on this particular opportunity, and Fund 3 is modeled quite similarly to Fund 1 and Fund 2, including underwriting metrics, which I'll explain in a moment. So our product is fairly simple. I think Kamal in the start of the conversation referred to fixed income as something boring, etc. And our goal, honestly, is try to be boring. We do not want excitement. The group is very, very conservative. They come from a history of conservative lending. In fact, people have made fun of Sundaram Finance, saying that, they follow the Hindu rate of growth and so on and so forth. But we are super comfortable in terms of, knowing what we do, understanding, where, the opportunity lies, measure ourselves against our own conservative risk-reward return matrix, and be very comfortable in if we say something to an investor, that's exactly what we do, and we do not do any style differentiation. And in fact, our credit committee comprises 3 sects of people. One is the promoters themselves. So the Vijay Santanam family actually are represented on the committee. And then there is Sundaram Home Finance, which is a tactical partner to the funds aside of being a sponsor. The CEO of Sundaram Housing Finance sits on the committee as well and approves every transaction. And third is obviously as fiduciary to sponsor capital, Sundaram Finance's finance director, because they provided a bulk of the sponsor capital, also sit and ensure that what we commit to them as investment policy and credit policy is exactly what is being followed in every single deal. So our credit committee is unanimous, and every deal has to be approved by pretty much everybody. So there is a very, very high governance and a compliance to what we tell investors in terms of what we do. But coming to the product itself, it is, sorry to disappoint you, but boring. It is a senior secured debt product where the goal is to mimic what a bank would do. Essentially, our investment, because we are AIFs, are structured as NCDs, but essentially the structure is that we have a mortgage of underlying assets, whether they be land, they be completed inventory, unsold inventory, rights, anything that can be monetized and is tangible and mortgageable is mortgaged to us, essentially to the extent of 2 times. So all our loans are 50% loan to value at our valuations. There are independent valuations done for every single transaction by third-party guys, and those are audited every quarter. So essentially, we have significant amount of equity and loan to value backing all our investments, which is again one of the reasons why we got paid down, during the COVID crisis also. The second is that 100% of our investments, have a complete escrow of all cash coming from the underlying projects. So essentially, we have while RERA stipulates that 70% has to be towards project and 30% can actually be taken out by the developer. In our case, there is no takeout. 100% of the cash coming into the escrow from sales is first used to pay us or service our loan, and secondly goes into the project. There is no third use. So essentially, the developer has a choice of whether to prepay us or accelerate the project, and keep him focused and highly disciplined in terms of generating cash out of those projects that are mortgaged and escrowed to us. Aside of the mortgage of 2x and the escrow of 100% of cash flow, we also have corporate guarantees, that enable us to, enforce against the company. We have personal guarantees from the promoters that enable us to enforce against the promoter if need be. We have a series of negative covenants, including post-dated checks, contractual rights to step into the project, and all of the things that you might have heard from other similar funds, etc. And so there is a very significant amount of, I would say, structuring to ensure that there is a complete alignment of interest between us and the developer. And our focus is very, very clear, whether we write a 3-year loan door-to-door or a 4-year loan door-to-door, which is what we've largely done, 3 to 4 year loans. Every quarter, there has to be an interest payment. There has to be a compliance to a pre-agreed business plan in terms of sales, velocity, etc. If there is a difference, we want to pick that potential to stray away from the plan as early as possible and not as late as possible. So, we don't offer things like pay when able, redemption premiums, long dated maturities, give long moratoriums, essentially back end the payment against the NCD, etc. For us, it's every quarter we need an interest, and the maximum moratorium that we give is for 6 months to 12 months. Beyond that, the principal has to start paying every quarter, like any bank loan. And essentially, what that does is enforces, as I said earlier, the discipline for the developer to constantly keep churning cash from the underlying projects, and for us to be able to distribute that cash back to investors and keep that current yielding model as a fixed income instrument back to the investor. So if you see in terms of ALM for the fund itself, which is the sort of significant risk management that we do, is Fund 1 is a 4-year fund where the credit policy is that we cannot do more than 3 years of door-to-door. And within that, all loans are amortizing. So essentially, average duration for every loan is about 2 to 2.5 years. So on a 4-year fund, we run 2 to 2.5 year maturities on a deal-by-deal basis. So even if there are potential problems in a couple of the portfolio companies, we have enough time already built in to the fund maturities to be able to resolve those and return cash back to the investor at the end of the fund duration. So we don't end up on a 4-year fund writing a 4-year deal and figuring out at the end of the 4 years that, oh, there is a problem in a couple of accounts and now we need to extend the fund and we need to communicate to investors and so on and so forth. So we built that from an ALM point of view into the fund structure itself and the underwriting structure itself. Similarly, in Fund 2, it's a 5-year fund where the maximum tenor that we can write a loan is 4 years and average duration is between 3 to 3.5 years. So again, the same policy and concept applies. In addition to being senior secured 2x, in addition to escrow of cash, in addition to corporate and personal guarantees, all the creditor rights that you can think of and so on. So essentially, because we have sort of self-imposed all of these conditionalities on ourselves and the governance structure that we have ensures that we strictly follow it, our conversion rates are very, very low. So we need to run pretty high degrees of pipeline. Our conversion rate is about 1 in 10 deals. So which means if we have to do 400 crores of deployment, we have to run a 4,000 crore pipeline because essentially only 10% of that pipeline makes it through all our filters into actual consummation of deals. So, we are quite happy, with that kind of filtration and conservative process. While we've let go of many opportunities, which we could have otherwise done with potentially very good names and so on and so forth, the group is pretty comfortable in terms of the risk and the credit policy that we have to ensure that we stick to what we commit and this is what we do. So aside of all this, there are two significant nuances. Usually I start with that and end with this, but I thought in your case I will go through typically how we do deals and end with these two nuances because these are quite pivotal and significant as nuances between what we do and in my personal understanding and to my knowledge what others do in the market. These are real differentiators. The first is that we do not enter any early stage project. So essentially the projects that we finance, land has to have been acquired, all title has to be diligenced, all approvals have to have been secured, the project ought to have been launched, anywhere between 10 to 50% sales, maybe somewhat constructed. So essentially these are brownfield situations that we enter into where we are able to diligence the price, we are able to talk to customers, we understand there is cash flow already coming in, there is sold receivables that is already backing some of the working capital required in the project. So when we enter, essentially a lot of the early stage risks, which in my personal opinion, having done real estate financing for a decade, is where a lot of the investors get stuck, is because there are delays in land acquisition, there are cash components that people can't get their arms around, there is political interventions in terms of approvals and so on. There are approval delays because one has to go and get some aviation approval from somewhere and so on. So despite the best of intents and efforts and initiative of the developer, if there is a delay, then your investment is impacted for sure. So a significant portion of the real estate investments, they tend to be in early stages because there is a lure of high yield between 20, 22, 25%, and all these numbers you may hear from our respected brethren and healthy competitors is something that we are quite happy to forego, and saying we are quite happy to make our 18% return and not take those kind of risks is the sort of trade-off that we as a management have decided. And consequently, our goal is to enter brownfield, see highly visible cash flows. And when I say that, we are going to commit to make quarterly interest payments and distributions, etc., that has to be backed by actual cash flow from the underlying project. So we prefer to enter situations where there is already a cash flow generation, which we can help build and scale and so on and so forth. So essentially, it's growth capital that we provide. The second systemic risk in real estate, again, despite best of intentions of developers, etc., tend to be the sales velocity slowdown. So essentially, again, if a project suddenly starts selling slower for whatever reason, again, the investment is impacted. So what we have decided is that we will not be doing any single asset financing. So for every single loan that we do, which tends to be between 40 to 60 odd crores, we need a minimum of 2 running projects and generating cash flow to be able to do that deal. So essentially, there are 2 running cash flow projects that are mortgaged and escrowed to us. So even if there is a slowdown in one project, another project cash flow kicks in and continues to service our loan. This is again a significant reason why during COVID lockdown we were able to continue to collect cash. So these two, I feel, are genuine nuances that we follow. And again, this comes from an understanding and a deep appreciation of credit and a sort of a conservative approach to financing, and truly structure a product as a fixed income, despite the sector lending itself more to an equity type project financing, as I mentioned upfront in my presentation. So the goal is to try and convert what typically real estate financing is, which is an early stage project financing business, to a more enterprise corporate level credit with multiple cash flows rolled into servicing our loan, where we are seen as secured, sole charge, significant covers in terms of loan to value, and a consistent sort of recovery of cash from the underlying asset. So, this is the way we believe truly when we say that, this is a fixed income product. And we've had this debate over the last 4 years with, many investors that we had, and saying, "Arey, how can you say that this is fixed income? How can you compare this to a Shriram Transport Finance bond or any corporate credit bond?" We are comfortable in saying that we can compare it, for the only reason is that while the underlying cash flows are from projects, they all aggregate as multiple projects, that form, more of an enterprise type cash flow back to us, and they are seen as secured and isolated to us. So it is not even, in fact, we feel it is one stage better than a typical corporate credit bond where cash flows are fungible and can move to multiple instruments, etc. Here in our case, the cash flow from our underlying assets come only to us, and we are sole and exclusive charge on those assets and that cash flow. So we feel that we've sort of created and designed an instrument that is mimicking a corporate credit risk, but at the same time isolating cash flows which are highly diligenceable and are brownfield in nature and not greenfield in terms of risk, that are mortgaged and escrow to us. So that, in a sense, is our product and our nuance and our feature. And of course, I can keep going on, where our counterparties are typically guys who've delivered 1 million square feet or more in their regional micro markets. We tend to focus on end pricing of inventory, which is between 50 lakhs to 1.5 crores for a unit. So whether they be a villa or an apartment or a plotted development, etc., in that sort of price bucket of 50 lakhs to 1.5 crores, we've seen the least disruption in terms of volatility and slowdown and so forth. It's plus minus 5%, but not more than that. So it's not as though these are luxury, super luxury, and so on, where capital values are so large that the affordability becomes an issue. And these are what typically housing finance companies and banks lend against the most. So, I would, while data is very difficult to get exactly, we would think that we cater to the first home buyer community, where we think between 60 and 75% of what we have financed as projects actually find buyers who are first-time home buyers and cater to genuine housing demand, especially considering that this is the price bracket there is. And our geographic focus, finally, is the South, for 2 fundamental reasons. When I say South, it means Chennai, Bangalore, and Hyderabad. We do not do Mumbai, Pune. We do not do NCR, etc. For 2 reasons. One, Sundaram as a group obviously is South focused. It's got significant presence, whether it's Sundaram Home Finance's offices, wherever we lend, whether it is Sundaram Finance's credit influence and due diligence ability and pre-investment diligence capability. And so the group is very, very prevalent in the areas that we lend, Chennai, Bangalore, and Hyderabad. And secondly, we think genuinely that the macroeconomics of the real estate space work better in the South than in the West and the North at this point in time. And we strongly believe that for several reasons, which are out there in research reports, where markets have already bottomed out in the South, lower capital values, relatively less levered in terms of developers, shorter gestation projects, so residual maturities being a lot less, less credit concentration. So a 50 crore problem in Bangalore would probably, my guess is, a 250 to 300 crore problem in Mumbai, for example. So essentially, when we are raising 500 to 1,000 crore funds or 500 to 600 crore funds, we believe in diversity, in creating diversity within those funds, where we actually do between 10 and 15% max of every fund into a single deal. So every fund will have 10 to 12 transactions at any point in time. So that diversity is something that can be meaningfully built more in the south than in the west and in the north, in our opinion. And the underlying macroeconomic and credit factors favor us focusing on the south. And in any case, from a pan-Indian real estate financing perspective, the south is anywhere between 30 to 40% of the whole financing market and the development market from a real estate standpoint. So that's sort of where our focus is, and we are quite comfortable that the opportunity is far in excess of the funds that we are trying to raise. So again, as I said, our goal is not to be heroic and raise thousands of crores, but our goal is to cater to the opportunity that is clear and present today. So if we raise 750 crores, and there are obviously lessons that we've learned from earlier funds that we would seek to be improved to improve and be better at in the coming funds. But we think there is substantial opportunity to deploy in the markets that we are focused on. I've already gone through this in terms of the governance framework. These are Fund 3 terms, but I'll probably leave that for another time. But since this is more about understanding the opportunity and seeing what we do and how we do it. But as I said before, I think our goal is to try and raise this money between now and April next year, because the opportunity is very live, and we're running nice pipelines at this point in time, and we are at the fag end of investment in Fund 2. So we would like to be in the market with Fund 3. So with that, I will pause. Kamal, you can shut off the presentation, and I'm happy to take questions.
Sure. I think you have given a detailed, presentation covering every aspect, but still, I will cover a few, questions, and kindly keep answers short so that we can cover, maximum number of questions. We have around 20 minutes for these questions. So conceptually, speaking, what you covered, that your focus is more on risk, is quite comforting, because I also believe that when it comes to fixed income asset class, though I myself quoted it is boring, but it is good that it is boring, right? Because risk is the foremost component when it comes to debt as an asset class, right? So returns could be a foremost, I would say, area of focus when it comes to equity, but for debt, risk is definitely important, and good that you have covered that. So to tap equity, to tap debt as an asset, to tap real estate as an asset class, which we have covered today, right? So I will just tell you quickly that I ran a poll while you were giving a presentation to understand that what is the opinion of audience in terms of possibility of making fine returns, by investing into real estate segment through financial product. And I can tell you, based on the results which are in front of me, 87% people said they have a very high opinion. They said yes, real estate as an asset class is good over next 5 years. So to tap real estate as an asset class, there are two ways to do that. One is investing in Reits. The other is maybe investing in a private credit fund. So from investors' perspective, how are these two different, conceptually speaking?
First, I would say returns, because I think REITs, essentially generate returns which are far lower than what we are seeking to return. So essentially, if I'm not mistaken, the REIT returns are anywhere between 8 and 10%. And essentially what we are looking to do is to try and generate between 12 to 13% at a base case. And, that has, margin for scope for improvement and so on and so forth. So essentially one is return. The other is the asset class itself. So REITs essentially invest in commercial, fully leased properties. And essentially the yield to a REIT is actually coming out of lease rentals in a commercial building, IT park, so on and so forth. And while that is not necessarily, a wrong or a bad thing, and indeed, a proxy for India growth, but essentially what private credit funds have the flexibility to do differently is to diversify the underlying portfolio in terms of assets that specifically pick and choose those risk reward opportunities that offer a better return. So essentially there is a customization that is possible in private credit fund with a slightly better return, obviously with a proven manager and so on and so forth. That goes without saying. And similarly, in the case of a REIT, it is lower returns, but it is perceivably a safer asset class because they are fully leased commercial buildings. But essentially, I would say the risk is different between the two.
Sure. Another question, from investors' perspective, today to invest into category 2 of AIFs, which is the fixed income space, there are two types of options. As you also mentioned, this is the private credit space. On one side, there are such funds which market themselves by saying that we are investing into private credit by lending money to corporates, and we are taking collaterals which are kind of business financials, cash flows from business, and maybe the real estate property of the promoter or equity from the promoter. And while they market those products, they also mention and highlight that as their do's and don'ts. And in their don'ts, they mention that we don't invest in real estate, right? So basically, they are trying to market their product by conveying that kind of real estate is high risk, and hence they are not into that, and that is their unique factor. On the other side, now your product is focused on real estate, and you are trying to say that one can make high yield in private credit. Here, this is also a kind of a controlled risk mechanism and an interesting and attractive mechanism, which is equivalent to or maybe superior to the other instrument which I just mentioned. How do you compare these two in terms of risk return or any other aspect that you want to cover from investors' perspective?
Okay, my perspective is very clear on this. The first one that you mentioned is, in our definition, a corporate credit fund. And honestly, the fund that I alluded to at the beginning of my presentation, saying that later in the year we're going to launch a corporate credit, is exactly or some aspects of that. And essentially, where the end use of what you lend to is not for real estate development, but it is actually for something else, and you also take real estate collateral, etc. So one is a corporate credit fund, and what we do is front and center 101 real estate project financing. Now there are a series of funds that actually do a hybrid of the two, where essentially they position it as a real estate fund, but it's essentially a loan against property business. And those are risky, in our opinion, simply because neither are they focused on a business that is generating cash, and secondly, they're isolating themselves in potentially assets that can never sell over a period of time. So it's very hard. Those are equity type bets, and then you should position and say upfront very clearly that these are equity type risks. So our business, whether it's a corporate credit fund or the funds that we are executing right now in real estate, is to be very upfront in terms of what we are lending to, what is the risk we are taking, how are we mitigating ourselves, where is the money going to come to pay us back. And essentially, all of that points to a space, and that is really our classification of where our sectoral risk is. So nothing wrong with, there are funds like Anicut, for example, that take real estate collateral and lend to corporates, and they're doing quite well. But essentially, that's not a real estate investment. And it may be possible to create yields of 18-19% even in that fund, coming from a return perspective, similar to what we do. But I would argue that those are a little more opportunistic in their views, because you should come across situations where somebody is taking out their JV partner, or you are actually doing a venture debt business where you're taking a very early stage risk, and the promoter is basically giving his flat where he's staying as collateral, but he's raising money to start up a med tech business, for example. And so those are, I would say, more equity type risks that one ends up taking versus clearly we are trying to do a credit business. So in our view, this is, you have to be very clear on where you're going to get paid from, and is that cash flow generation consistent, predictable, visible. And if you have the answer to all that, that's pretty decent comparable business. But in our limited experience, on the example that you gave, some of those funds that lend to companies against real estate collateral tend to be quite opportunistic. And at the end of the day, if those businesses don't generate cash, or they are at a stage where they're going to take much longer, the real estate is something that you'll have to enforce in the market to be able to get your money back. And that actually becomes a distressed business. So you're actually moving from what you think is a growth business to a distressed business. And so the mindset of a manager, is quite important there. I know because I've done 15 years of distress, and I've actually invested $1 billion in distress situations and so on and etc. So the mindset has to be very, very different, and you have to be ready with that infrastructure, whether it is legal, commercial, technical, etc., to be able to enforce on that strategy. So long answer to your question, but we think that two are very differentiated strategies. There may be some sort of common part in terms of deals that we do, but we would prefer to invest and create a fund with a philosophy that can actually scale, where all deals can be looked at in the same template. So when anybody does a diligence on our 17 transactions, you would find exactly the same underwriting approach, the same template, the same diligence procedures, the same kind of counterparty filters, the same asset monitoring mechanism, that we would follow. So, these are, as I said in my earlier slide, highly templatized credit business as opposed to opportunistic businesses.
Karthik, you're a chartered accountant yourself, so I would want to ask, another real question that investors ask us. What happens, these category 2 funds, whether it be, a real estate backed fund or a business financials backed fund, right? They provide returns in form of some kind of interest coupon over a period of time. Also, as also they provide some kind of maturity premium as and when, the money, the NCD matures. So it leads to a kind of a ongoing cash flow, and hence the taxation is relatively complicated. And when all these existing clients, existing investors who are invested in these products, they go through this experience. So basis that in the chartered accountants community, there is this perspective, there is this I would say perception that kind of makes investors not invest in these products. So today, if any client of ours will talk to any reputed chartered accountant whether I should invest in any of these products, he will give his opinion that no, you should not invest, because he has gone through this tedious, I would say, working with some of the other earlier investors where he had to file taxes by going through a lot of transactions. Though obviously that is the work of a chartered accountant, and that should not be the reason for any investor to kind of decide in the fund or not. But how would you explain in a simple terms what is the post-tax return, what is the taxation, how should investor understand the post-tax kind of return and taxability of these funds?
So fundamentally, look, I qualified in 1997, so it doesn't, and I never practiced. So I wouldn't say I'm more of a business manager than a chartered accountant. But the answer to your question is very straightforward and simple. Whether it is category 2 fund, category 3 fund, category 1 fund, whatever it is, the taxation is very, very clear in terms of whatever maximum marginal rate that applies to an individual or a business will continue to apply regardless of what investment they make, when and where. Okay. Category 2, yes, there is unfortunately a confusion. Actually, it's not a confusion. It is very clear that essentially it's a tax pass-through vehicle. And so essentially all income of the fund is actually income of the investor. It's completely mirrored. And that is inconvenient, no doubt. And we've had lots of conversations with our investors in terms of, for example, if on April 30th, if there's an interest payment due, and if that comes in May 31st, he's having to actually pay tax as of April 30th on an accrued basis. So we've tried to modify our own backend ops in such a way that, if we foresee there are some delays and so on and so forth, we really don't accrue for that income itself, but we've tried our best to be investor friendly, but it is what it is. The way I look at it very simplistically is that if I generate an 18% or a 19% return, and if post all our asset management fees and carry and so on and so forth, we are able to generate around a 15% pre-tax return. So essentially, let's assume that people who invest in this fund are, belonging to the highest tax category. So essentially, they make anywhere, between, 11 to 12%. What we've seen our investors make. So essentially, that is the way it sort of flows as a waterfall. And the way our investors who have bet in us, and just to give you a sense, in Fund 1 we have 50% institutional investors, and Fund 2 we have, and the balance 50% we have HNIs and family offices and so on. Similarly in Fund 2 as well, and we expect the ratio to be quite similar in Fund 3 as well. So all high net worth investors who've invested in us invest on account of two reasons. One, I think trust is a often misused word, but essentially there is a comfort in a Sundaram name that what we say is what we will do, and essentially there is no style drift. So we're not going to say this is a credit fund and put it in equity opportunities and lose capital. There is a very high focus that these guys won't lose my capital. One is that my capital is safe from a risk point that you mentioned. Two is that from a return point of view, even despite all of these, this tax treatment and so on, ending, making anywhere between 10 to 12% post-tax return is something that they still believe, is a significant positive, considering the point number one and the fact that, comparable opportunities in terms of corporate bonds, etc. And it always comes down to allocation. And we've seen typically most high net worth investors have anywhere between 70-30 in terms of equity, private credit or other opportunity sort of mix within their investment portfolio decisions. And within that 30%, people have tended to make a choice that let me go with someone who's safe, whom I can trust, and the fact that these returns are, frankly, from a risk-adjusted senior secured basis, not bad at all, pretty attractive. So that is how investors have seen and made those choices. But yes, we would love for the tax to be a little more realistic in terms of mirroring for credit events and so on and so forth. So there is no burden, that extra that they have to bear, but it is what it is, and tax is something that nobody can change in the land. So considering all of that, what we've tried to do is to structure our investment thesis, our philosophy, our policies, our distributions, our liquidity management, treasury, all of that in a way that is ensuring capital protection and at the same time generating a base level of return which is highly competitive, with what any fixed income guy would look for, which is, I would think, closer to the West than to India, because I myself have bonds and so on and so forth, and those give me 4 to 6% post-tax return. So if I'm able to double that in terms of 10 to 12%, that's our goal. And on a 10 to 12% post-tax return, if we can actually generate this consistently with visibility and with Sundaram's governance and everything backing us, that gives comfort.
Sure. So to the audience, I would just like to add, another aspect, that whatever we have been discussing so far is, more for an education purpose. All of us understand that this is the space which is the private credit space, which has an element of credit risk and which is different from an interest rate risk. There have been a couple of questions which are trying to compare investing in this space with perpetual bonds. I would want to highlight that perpetual bonds have an element of interest rate risk, and because we could see over maybe next couple of years interest rate rising, so there will be that element of risk there. Similarly, this instrument offers a credit risk, but at the same time, we are trying to understand how this credit risk is being managed well, and there is no assurance of capital protection, there is no assurance of any return, but all these are indicative numbers that we have discussed, and a best endeavor which is being done to manage this fund. And I would also like to understand from you, Karthik, maybe as a last question, because as you pointed out in the beginning also, that risk is very important for any investor to actually feel attracted to think of in considering this asset class. The foremost thing that could come to mind, and someone has actually voiced this out also, that is that a 10 to 12% kind of a post-tax return kind of seems to be too good to be too true, given that we know the fixed income space is giving very low kind of returns. So what is the risk containment mechanism that you kind of follow? If you could take an example, that if there are maybe 5-6 deals in front of you, 5-6 proposals in front of you, how would you reject maybe 4 and accept 1?
Sure.
Yeah.
Sure. Let me address that in 2-3 ways. The first is, as I said somewhere 20 minutes ago, our filtration criteria is pretty intense. So essentially what we look at is 3 levels of diligence. The first is counterparty itself, where are they having requisite track record, have they delivered 1 million square feet, which is quite substantial in the south. It may be nothing in NCR, but it's quite substantial in the south. Are they current and relevant? Do they have an enterprise? All sorts of forensic audit, etc., in terms of background checks and so on. So that's promoter level filtration. Second is at a at a deal level, are we entering the right project? Is it priced correctly within the price bracket of 50 lakhs to 1.5 crores? Is velocity there in that micro market?
Just to intervene, Karthik, this is a very important question. Can you please, take mic in your hand? It will be more clear. Yeah.
Sure. Is this better?
Yeah, this is better. Absolutely.
Okay. So I was saying at the first level, the promoter level diligence is pretty intense in terms of track record, delivery, current relevance, current sales record, feedback on last mile execution from Sundaram Home Finance on their earlier projects and so on. That's one level of diligence. The second is that, the project itself, at what stage are we entering? Is it already selling? Is it all post approvals? Is there visibility of sold receivables? Is there a traction on the project vis-a-vis other projects in the locality? Is there additional FSI that's possible that's going to create further value? And so there is a whole series of project level diligence that happens. Second. Third is the credit structuring level, where does the developer have, as I said, multiple projects to be able to give to us as security? For example, if one slows down, as I mentioned, the other kicks in and pays us off. So, is he sort of mortgaging a substantial portion of his enterprise? So, for example, in Fund 1, for every single deal, we have, I think, as a minimum, 3 projects, if not 4 projects mortgaged to us, all generating cash. In Fund 2, we have, I think, on an average, about 2 to 2.5 projects, and I'm just mathematically speaking. So, essentially, is there sufficient cash generating collateral in terms of projects that is mortgaged and escrow to us? And of course, is it meeting all our other criteria in terms of 2x asset cover? Is the cash flow trajectory in such a way that it can service a quarterly coupon? Is it capable of amortizing over a period of time? If our loan is 4 years, is the project actually going to end in 3 years, or is it going to end in 7 years? So all those sort of residual maturity assessments, etc., are 3 levels of diligence that we do, and all of these are very transparent and there in our credit policy itself. So these are not subjective case-by-case assessments and evaluations. These are there for all deals to follow, and this is part of a standard credit policy that we're following for Fund 1, Fund 2, and indeed Fund 3. So this is first to assure ourselves that we are entering the right deal at the right stage with the right counterparty and with the right set of collateral, that we can get. This is one level. The second level is obviously, as I mentioned, from a fund point of view itself, as a portfolio, are all deals capable of generating that sort of return? So at a portfolio level, if you've seen my track record chart, it's generating 19%. All deals should be capable of generating that component of current yield, which is 15 to 17% on a quarter-on-quarter basis, and so that post fees, what we distribute back to the investor is something meaningful, on a quarterly basis. Second is that obviously at a portfolio level, are we making the right deals at the right time at the right durations? So we decided, for example, in Fund 1 to do a deal in the early part of this year with a South group called Shakti, where we lent at 24% return, but it's only a 1-year deal, essentially backed almost by bank guarantees and fixed deposits, frankly. So we don't even have to go into the real estate piece of it. But essentially, the goal is to try at the portfolio level also to populate the portfolio with deals that keep the sort of velocity as far as returns going, to ensure that that number, which is too good to be true, and I agree with that assessment, is something that can reasonably be delivered, and we can sort of have mechanisms to catch up with that. At the third level, as I said, always fundamentally at the core of all of Sundaram's decisions is capital protection. So essentially, a combination of all what I said. Our goal is first to say that, okay, bhai, at the end of the day, first let us return 100% of the capital in the most efficient way possible. So if we are 83% with a year and 2 months to go in terms of the Fund 1 maturing, we've done a good job of that. So essentially, from now till October 2022, which is when Fund 1 is ending, our goal is to try and squeeze for return now, because the capital protection and return of capital is a guarantee now in Fund 1. So the goal is to now shoot for returns and try and beat that hurdle rate of 12% between now and October 22. So that's the thinking and the way the fund management works for us. So first, capital protection, despite accidents and so on and so forth, delays and everything, we must capital protect and then shoot for returns. So that being the philosophy, it is not uncommon for us to have had issues. So, for example, quickly again to go into one of the other questions you asked, out of the 12 deals that we did in Fund 1, 3 deals are fully exited at 21% IRR. Of the balance 9 deals, 7 deals are amortizing as per contract, which means no change in the base case despite all issues and so on and so forth. 2 deals have delayed, both in Bangalore to us, wherein one of those 2 deals we have recovered 85% of the capital and we're shooting for 100% of capital. In the second deal, we've recovered 30%, and there have been some credit issues in the company. But the security underlying that second deal, which is a company called Peninsula, by the way, is almost at a little over 2x, close to 2.4x cover. So there is substantial equity below us. So there is no credit event as such in terms of write-off of capital, etc. But there is a delay in terms of time that it takes to monetize from those underlying assets, which is currently what is happening. We've gotten another developer to come and take over a couple of the land parcels that were mortgaged to us, do a plotted development on that, and actually get paid out. So it is more a delay of monetization of asset from the base case versus losing capital completely and not understanding what to do, or having dud assets, which cannot be monetized at all. Those are all situations we don't see in our portfolio. We fundamentally protect capital through the quality of the underwriting and the assets that we sort of mortgage to us, and start aggressively and intensively working towards monetizing each of those assets so that we are always as close to our base case as possible. So this is how we typically go about protecting capital and generating returns, and this is exactly the same policy that we are following in Fund 2 and which we will follow for Fund 3.
Right. I think this has been very, very insightful. Most of the questions have been answered. Last word of I would say advice for any of the investors who are looking to invest in the real estate space over the next 5 years, maybe by Vijayendiran. Over to you, Vijayendiran, if you would want to give any last piece of advice to all our listeners.
No, I just wanted, what Karthik has been mentioning, the most important is the difficult time we have really mastered this space, managing this space with a strong filter, a good credit policy, good internal credit policy, so that we make sure that we lend to the right people. And most important is to continuously monitor those projects and making sure that what the builder says and what he does on the ground is the same. And this is very essential because you have seen historically, if you look at the real estate cycle, what are the things which have gone wrong is if you look at the land level, what Karthik clearly said, we don't look at it. We come in only post-approval. The important thing, if you look at the last 20, 25 years of the real estate space, what has gone wrong is the land level approval delay because of political issues and so on. And the whole project gets derailed because of that. So we have avoided that. The most important is if you fund the construction will go smoothly. The most second thing is to make sure the monitoring that construction happens in the way it should be. The third important is make sure you are in the right micro markets in real estate space, meaning at what price points your flats are being developed and sold. So here also we have made sure, as Karthik mentioned clearly, between 50 lakhs to 1.5 crores. And this is where the India middle income or slightly higher middle income, the employed salary class comes into play. And that's what we have seen. The sales velocity has been very strong in our projects, which has helped us to get the quarterly coupons coming from the developers. What we pay to investor is coming from the developers. So that is also we have achieved. And why this third fund again real estate is, I think we have crossed the toughest cycle now. So we are seeing a new cycle emerging in the real estate space. We have crossed the trough, and I feel we are in a very good time span over the next 5 years. I won't agree more than some of your investors who have replied to your polls and said that they look forward for the next 5 years. We also believe similarly that we are going to see a very good real estate cycle coming through in the next 5 years. And this will be funded not by the banks, but by the AIFs and foreign investors, foreign long-term pension funds, sovereign funds, and so on. So you could see a very interesting space, and with more money flow happening, it is like the equity market where more monies flow in, the markets go up much substantially than the actual intrinsic value is. Real estate space also will go through that. So what it means to a fund manager like us is that better risk managed and reasonably good returns. And that's what we want to ensure to our investors. And we are always making sure, as Karthik put it, the investors' experience with us should be very good. And we want to do that continuously in the way Sundaram group operates. And that's what we are. So that's why we are very clear what we want to do. We will do it well, and making sure, try to filter off the risk in this space. And when the tailwind comes back after long years, when the cycle is turning positive for us, I think we are in a very comfortable space to ride that wave, because of the last 4-5 years experience will help us to take it forward, the third fund, in a better return, better investment, and give a good investor experience.
Thank you so much, Vijayendiran. I think it has been very detailed and very fine, discussing on this particular topic. And thank you, Karthik, for enlightening, and answering all those questions, which were real investor questions. And all the very best to you guys. Thank you so much.
Thank you so much.
Thank you very much. Thanks for the time. Thank you all.